All right, everybody, welcome. My name is Doug McKay, and today is the 24th of March, 2020. We're going to have a very simple presentation here. What I'm going to do is I'm going to walk you through exactly what we're doing in the stock market now, what we've done in the last couple of weeks, and what we anticipate doing regardless of market direction moving forward. In addition to that, and again, that will be managing the risk in the stock market as opposed to a buy and hold, one size fits all. And then we're going to talk a little bit about safety of principle, how you can so-called stop the bleeding, eliminate the risk, but have the potential for upside gains. So those two together we often refer to as the happy meal. This gives you a big picture going back over 120 years of the Dow Jones Industrial Average. And it's not really important that you're able to depict on here because it's awfully small, each little incident, whether it be an up move, down move, etc. Point being is this gives you an idea as to the stock market strength over a period of time, whether it's through the Depression, Great Recession, the 16 years from 1966 to 1982, where essentially the market was flat, or the 2008 Lehman collapse. So if you're a long-term participant in the stock market, provided you're buying quality stocks or possibly quality funds, this is the place to be. And we still believe today in 2020, even prior to the 35% hit in the market, that stocks were the most reasonably priced as opposed to all other assets, especially US-based stocks. All right, so again, we're going to keep this short. We're going to break this particular slide down into three categories. Existing clients. Discipline is the key, and we want to make sure that whatever got us here to begin with in terms of our portfolio returns last year, whether it was done by Gary and I or a combo of Gary and I and Rob, our head portfolio manager, is we continue that strategy moving forward. Typically, stocks that excelled prior to getting hit are the ones that are also going to move when things eventually take off again, which could have started potentially today. And we'll look at a chart as we get into this. But anyway, assess your current portfolio, make adjustments as necessary. Many people, and they don't know this, and it's not their fault because it's not their profession, own stocks in particular mutual funds or in their portfolio that have underperformed even at stock market highs. So it's important to kind of cut the losers short and let the winners run. And that involves a tactical strategy. And that's what we did last year. And again, past performance is not indicative of future returns, but that's what gave our tactical opportunity strategy a 41% return versus the S&P, which was around the 28% area. So review overall asset allocation. Only long-term money should be in the market for a buy and hold strategy. Buy and hold. And having said that, those stocks that you're holding, that we are holding currently, need to be good quality stocks. All right. New clients, very important. Some of you are existing clients. Some of you hopefully will be new clients. Again, we want to pick the winners, the stocks that have performed historically over the last 2 or 3 years. And what we will do is we will put the cash to work when we see the stock market most advantageous to us. So if there's an extreme run-up for a period of days or weeks, we'll wait for a pullback. This is, again, the exact implementing that we did over the past 3 years, which gave us good returns. All right? So the idea here are quality companies and then putting your foot down in the market when the market dictates that in terms of any type of pattern. Prospective clients, again, the best companies right now are on sale. So if you are looking out over a period of time, it's on sale. You should definitely start to dollar cost average into the market, either on your own or with us or somebody that typically knows what they're doing. Again, investing during these times, whether it was the bottom in 09, I believe it was March 9th, so we're talking 11 years ago, this has led to historically great returns, all right? The old saying, one man's food is another man's poison. So again, if you're going to be in the stock market, if you have a long-term view, pick good stocks, all right? This is a chart that I put up yesterday on the 23rd on our blog this week on wallstreet.com. And this is a chart of the SPY, and that is a ETF that represents the S&P 500. Many of you might know that, but I'm just going to talk and assume that most don't. So this is one way of buying the entire index with one symbol very inexpensively in terms of commissions. In this case, they would be mostly free, where you can have exposure and obviously diversity with 500 stocks, the S&P 500 with one symbol. Now, what we're trying to do here is show you, based on this chart, how overdone and how oversold and what an amazing drop this particular SPY ETF has taken. Now, that's not to say that we couldn't rally up here like we have today and eventually retest some type of level of support, which would be 2,000 on the S&P 500 or 200 on the SPY. This might be some time, could be a number of weeks, months, could possibly even be years before the SPY or the S&P 500 gets through all this overhead supply, meaning all of this big collapse, all right? But we do look like, possibly today, because there is some support through here, if not soon, like there'll be major support going back all the way to 2016, 2015 at 200 or 2,000 on the SPY. The point being with this is we just don't want to listen to the news and the noise. We want to look both technically and fundamentally. Technically, where the market is it oversold? Is the fear index, the VIX, high? Typically, that's a contrarian indicator. And then we use all of these tools to step into the market and pick individual stocks. And if somebody has a smaller account and it doesn't make sense to pick individual stocks, we can turn around and go ahead and buy the index or an ETF like the SPY. All right. Let's take a look at the Dow Jones Industrial Average. This is a chart that we put up on our blog this week on wallstreet.com last night. This is just a screen capture. This is a little cloudy here. But this was when the Dow Jones Industrial Average was up in the night session around 480 some points. And I put this post out at that time, and I said, technically speaking, near here, meaning we can see support going back to, again, 2016, 2015. Near here on the Dow Jones Industrial Average is a highly probable opportunity for a bounce and to put some money to work. Okay, so this is where we believe that the knife might stop falling and the bleeding might subside for a while. And possibly this could be a bottom, possibly not. But having said that, it's highly probable that we were going to get a bounce here, and that did happen today. So even though in the night session we were up a little bit less than 500 points, today the Dow finished up 2,000 points. So that was actually a good call, and it wasn't luck. We're just using probabilities with the Dow being considerably oversold, where the fear index, the VIX, the volatility index, was extremely high, higher than 1987, higher than 2008, 2009 Lehman collapse, and therefore it was highly probable, with support, with the market being oversold, and with the fear index, again being a contrarian indicator, that the market would bounce. And again, it was up 2,000 points today. Okay, summary on stocks, and then we're going to get over to the safe stuff. Stay with what has worked prior to this. And for us as money managers, that has been picking individual stocks, good stocks, typically owning about 30, 32 individual stocks, not being too heavy in any one individual stocks, and getting rid of any stocks that are underperforming. Okay. Again, these companies, the good companies, all companies now, for the most part, will be on sale, have been on sale. Now, this is very important. Many clients that we run into, this third bullet here, they do not know what they own. Not their fault. They just they gravitate towards what they want to believe and what they want. So many people own mutual funds. We're not a big fan of mutual funds. None of our managed accounts have mutual funds in them. They either have exchange traded funds if they're smaller, or they have individual stocks, as we discussed. So the problem with owning mutual funds is it is kind of a one size fits all, where the garbage stocks are also in there with the good stocks, as are the garbage bonds and the good bonds. All right. Now, if you're younger, it's okay to own a mutual fund, and you can simply dollar cost average in. So you're buying at the highs, the lows, in the in-between. Okay, and if you ever want to give us a call or reach out to us, we can go through each situation individually for you based on your circumstance, your age, your risk tolerance. Are you about to retire? Is it a 401k, 403b, IRA, Roth IRA, etc.? Okay, now that took care of individual stocks. The market is oversold. Stocks are on sale. Buy good stocks. Possibly we go lower, or we get an incredible bounce here. We come back and we test and we hold. We'll see moving forward. However, nothing has changed in the economy other than this black swan event. This was not a Lehman collapse where the banks were in trouble. Everything was firing on all cylinders. So if things get back to normal, we expect that to get back to normal as well. Okay, so many of you possibly would be interested in the Happy Meal, or possibly no stock market direct risk exposure at all, regardless of how it's being tactically managed. We call that protecting the income and growing the rest. So what a fixed index annuity does, not a variable annuity, but a fixed index annuity guarantees your principal. So let's just use the case of $100,000. If someone puts $100,000 into a fixed index annuity, unless they take the money out early, regardless of how the index that particular fixed index annuity is tied to, let's just say an index goes down 20%, you do not lose any of your original principal. So you have safety of principal with potential gains. And I'll get into that in a moment here. So there's really two ways to use a fixed annuity. One would be for accumulation. Somebody that says, hey, I want my principal safe, whether I'm 25, 45, 75. I don't want any risk, but I want the opportunity to have an index that's linked to the stock market or various structured assets that will accumulate. That could be bonds, it could be stocks, it could be a small percentage of something that's tied to commodities, etc. So this is an opportunity, a fixed index annuity, to have potential gains with zero risk to your principal. Okay, and I'm going to show you that here briefly, or in a minute. Now, many people, especially today, and a lot of our clients, especially clients that have a lot of money, use this as a personal pension. Typically today pensions are gone for most. So what you're able to do is set this up in such a way where you have a guaranteed income for life, and you decide when you want to turn it on. And that particular institution, that insurance company, whether it's a Lincoln or a Nationwide or a Prudential, etc., they have to pay you that amount for life. And that's what we call having a fixed income annuity, fixed index annuity with an income rider. Okay. we can always, I don't want this to be a sales pitch, but we can always run scenarios based on your age, your spouse's age, etc. And you can see exactly what these numbers will be, guaranteed for the rest of your life. And one of the reasons people like this, whether they have 10,000 or 5 million, is because it's a guarantee. It's a certainty, so you can plan. Where the stock market, as we've seen over the last 3 weeks, is not a certainty. Okay, especially if you're a one size set it, forget it, as opposed to tactically managing it. So these are really good. And again, don't ever feel obligated to myself or my partner Gary. If you want to call us, if you want to text us directly, if you want to email us, we can run a scenario for you. We'll tell you exactly what we're doing. We are fee-based advisors. That means we don't have to sell you anything. The more your account grows, the better both of us do. Okay, we're getting into a little bit of inside baseball here, but one of the fixed index annuities that we use, again, no risk to original principal, is tied to a Barclays Trailblazer Sector 5 index. Now again, regardless of what the Trailblazer index does, in this case the symbol is TBZ, you can't lose original principal. So again, if you put 100 grand in and the Trailblazer index goes down 4%, like it did in the last week of February, you don't lose any of that original principal of 100,000. The reason I pulled this up today, and again, we're only dealing with 13 slides, is I wanted to show you how little the volatility is on this Trailblazer index. So when the S&P 500, SPX, S&P 500 cash they call it, was down 11.5%, the Trailblazer was down just 4.32, and this was, again, the last week of February. Then we had the Super Tuesday, where markets bounced back a little bit. S&P was up a little over 0.5%, and the Trailblazer index was up 1.57. So this kind of gives you an idea. Worst day in the markets for the S&P back then. S&P was down 7.6%. Trailblazer was down 1.13. So this is very important to know. Not only does this particular fixed index annuity, which we like at this time, there's many out there, but this seems to be our favorite, because you have obviously no risk to principal, and you have unlimited upside potential. So that's very nice. And we can kind of get into the weeds in that if you give us a call. We'll show you exactly how this works with PDFs and disclosure, disclaimers, etc. All right? Okay, so there's a lot of rotation. One of the reasons that, there's no rotating in the S&P 500, it is what it is, but there's a lot of rotation in this. This particular index rotated 7 times in a period of about a week, and this is why the Trailblazer index, the Sector 5, Barclays, did not tank versus the S&P that did. All right. So again, to recap on that, if you're going to be in the stock market, have a long-term view, but pick good stocks, all right? And if you don't want the risk, go with a fixed index annuity with potential for gains. And if you want to be able to sleep at night and kind of have a combination of the two, you can always go with the Happy Meal, okay? And it's on a case-by-case basis. This is just briefly us, First Fiduciary Advisors. You can find us at thisweekonwallstreet.com. That's a little easier to remember than First Fiduciary Advisors. A fiduciary, we work for the client. We don't work for a brokerage house. We don't work for the bank. I've been in the business since '94. My partner Gary's been in the business since the early '80s. Former floor trader, Chicago Mercantile Exchange. So between the two of us, we have essentially 60 years of experience. We also have a head portfolio manager, Rob Rayburn. Did very, very well last year. Again, past performance is not indicative of future results. Anyway, you guys, I want to thank you for your time today. Again, this is our blog. We're always posting on there this week on wallstreet.com. This is the site. This is just a QR code. And also, we have a new 2020 Investors Guide on Amazon. If you email or text us or call us, we will send you a PDF of that for free, of course. All right. I think you'll like this. This covers everything from the stock market to safe stuff to life insurance to trusts to Roth IRA to rolling your 401k, et cetera, et cetera. So that's available free. And we always say education without action is wasted. I don't know if we can help you, but we'll certainly find out if we can very shortly. And in many cases, sometimes clients or potential clients believe that they have something that they don't, and that can work both ways. Sometimes we have clients that say, oh, I have this and this person sold me that, and we'll look at it and say, you know what, actually that's pretty good. So that can put them at ease as well. And then other times people don't have any idea what they own. So our goal is to help you. If you give, you get. What goes around comes around. Again, we're not under any pressure to sell you anything. We're here to educate you and let the chips fall where they may. Everything we talk about, there's a big disclaimer on the blog, but anything that we send you will have disclaimers, our license numbers. This presentation today was not investment advice. Past performance is not indicative of future results. This just gives you an idea as to what we're doing with our clients in the market, and by no way, shape, or form is this any suggestions as to what you should do. All right, you guys, thank you for your time. Quick video. Any questions, again, you can call us directly on our cells. You have total access. We're in California. We are in Florida. I go back and forth. Gary's based Central Coast of California, but I go back and forth between San Diego and Miami often, and we often do workshops. Our latest workshop was in San Luis Obispo. All right, have a good day. This is Doug McKay on the 24th of March, 2020. Thank you.